Ladies and gentlemen, good day and welcome to the Yes Bank's Q3 FY24 earnings conference call. On the management panel, we have with us today Mr. Prashant Kumar, MD and CEO, Mr. Rajan Pental, Executive Director, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Manish Jain, Country Head, Wholesale Banking, Mr. Pankaj Sharma, Chief Strategy and Transformation Officer, and Mr. Sunil Parnami, Head of Investor Relations. Mr. Prashant Kumar will give an overview of the results, which will be followed by a question and answer session. As a reminder, all participant lines will be in the listen-only mode. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar. Thank you, and over to you, sir.
Very good morning, and thank you for joining us so early in the day for our quarter 3 earnings calls. On this call, I am joined by the senior team members of the bank. Before I share the key highlights of the previous quarter, I would like to start with the big picture and take you through our core strategy, its underlying drivers, and the critical business levers of our profitability improvement roadmap. On page 5 of our investor presentation, we have tabulated the balance sheet mix and ROA tree of fiscal 23 of Yes Bank, side by side with the average of our mid and large size peers. And from there you would see that fundamentally there are 5 underlying drivers or anchors which in our assessment have the maximum bearing in our net income improvement. Reduction in our PSL shortfall, number 1. Improvement in our CASA mix, number 2. Improving our asset yields through risk-calibrated mix change, number 3. Increasing our non-interest income, and lastly, reducing our cost-to-income ratio. Our focus strategy to address the above issues has already started to reflect in numbers for the current financial year. Our organic accretion in PSL sub-buckets of small and marginal farmer, non-corporate farmer and weaker section is already up by 1.6x, 1.4x and 1.2x from March 23 levels. Together with the other inorganic interventions, bank has seen a meaningful reduction in the above subcategory shortfalls. We have also made our branches becoming the key fulcrums of our entire business strategy. By Q3, the share of our branch banking deposits in our total bank deposits has increased to 55% from 52% in beginning of the year. Despite a challenging environment in 12 months, our branch banking CASA has grown 18.2% compared to 12.2% at Yes Bank and 7.2% for peers. In retail advances, the share of internal sourcing has improved to 43% from 37% at the beginning of the year. Since March 23, the share of higher ROA accretive products has improved by 8%. In all 3 quarters of current fiscal, the YOY core fee income growth has been between 23 to 35%, as a result of which Core fee as a percentage of total assets has increased from 1.1% in March to 1.2% in December 23 quarter. The strong focus on SME and mid-market segment, which are growing at 25% plus. Both are high-quality book with significantly low NPA levels across business cycles. Both the businesses are good source of fee income and low-cost liabilities. Our strategy to build an agile organization through review of org structure, process improvement, and cost optimization have already started yielding results. Quarter 3 is successive quarter of less than 1% quarter-on-quarter growth in operating expenses. Now let me quickly take you through the highlights of the third quarter. Our YOY deposit growth, excluding certificate of deposit, is at 15%, and which is higher than our YOY advances growth of 13.6% after excluding the interbank reverse repo, which was there in the third quarter of the last financial year. Within deposits in quarter 3, our CASA ratio sequentially improved to 29.7% from 29.4%, led by a 7% sequential growth in saving accounts and marginal improvement in the current account. We added nearly 4 lakh new retail CASA accounts during the quarter, and 80% of individual and sole proprietor current accounts and 96% of eligible saving accounts were opened digitally. Despite a persistently challenging environment in trailing 12 months, we have continued to see an outperformance in total branch banking deposits, which have grown by 22% YOY. The outperformance was even more in case of branch banking CASA deposit, and the incremental branch banking CASA ratio is coming at 30% plus over the same period. Within advances, we saw sustained momentum in our SME and mid-market segments. Both are up 24% and 26.4% YOY respectively. Our CD ratio at December quarter end was 89.9, nearly flattish on YOY and quarter-on-quarter basis. Average liquidity coverage ratio for the quarter was healthy at 118.4. CET ratio for the quarter was at 12.6, which is 13% in quarter 3 and 13.1% in quarter 2 of the current financial year. The impact of regulatory mandated increase in risk weights was 40 basis points, which was fully offset by organic CET accretion, including profits of 50 basis points. As communicated earlier, we expect another 100 to 110 basis point of accretion in CET ratio post the conversion of outstanding warrants. Moving over to margins, operating expenses, and asset quality and the profitability. Despite headwinds on deposits and funding cost, our net interest margin expanded by 10 basis points quarter-on-quarter and came in at 2.4% against 2.3% last quarter, which is largely driven by efficient balance sheet management, even as the advances yield and the cost of funds remain largely flattish. In quarter 3, our non-interest income was at 1,195 crores, and adjusting for realized, unrealized gains on the investment, the core non-interest income has grown by 23.4% YOY. As I was sharing earlier, December quarter was second successive quarter of less than 1% quarter-on-quarter increase in the OpEx. Operating expenses were at 2,347 crores, up 10.6% YOY and only 0.6% quarter-on-quarter. Adjusting for the PSLC cost, operating expenses are up only by 7.2% YOY and have actually declined by 0.8% quarter-on-quarter. Provision costs came in at 0.6%, which is flattish quarter-on-quarter despite 0.5% aging-related provisions on the security receipts during the quarter. AIF-related provisions have been fully absorbed at 12.5 crores. There was an all-round improvement in asset quality with 30 basis point quarter-on-quarter reduction in net NPA and net carrying value of security receipt as percentage of advances, which improved to 1.7% in quarter 3 against 2.5% in the corresponding quarter last year and 2% in the previous quarter. A strong resolution momentum continued with recoveries and resolution at 1,316 crores in current quarter. Since ARC transaction in December 22, there has been cumulative redemption of 2,836 crores in the security receipts. Slippage, GNPA, NNPA ratios have been flattish quarter-on-quarter. The provision coverage ratio marginally improved to 56.6%, and including technical write-off, the provision coverage ratio is 71.9%. Our quarter 3 net profit at 231 crores is up by 349% YOY and 2.8% quarter-on-quarter. The other key highlights. Last quarter, we went live on interoperable cardless cash withdrawal framework, which allows withdrawal of cash from ATMs via UPI without using any card. We also integrated with a leading discount stock brokerage firm to offer secondary ASPA services to our customers. We also made new strides in responsible banking, and our bank has topped amongst all Indian banks with highest S&P Global ESG score in 2023. We have been included in BSE Next 50 and BSE 100 indices. In January 24, we achieved yet another feat of being certified as a great place to work, second year in a row. During the quarter, we were also joined by Mr. Tushar Patankar as a Chief Risk Officer and Mr. Rajat Chalani as the Chief Compliance Officer. Thank you once again for joining us so early in the day, and now we can take your questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and 1 to ask questions. The first question is from the line of Deepak from Aryan Share and Stock Brokers. Please go ahead.
Good morning, sir.
Yeah, good morning.
Yeah. And congratulations for a very good quarter.
Yeah, thank you. Thank you, Deepak.
Yeah. So I just want to know, is there anything in future for the 81 bonds? any provisions to be made?
Deepak, I think this issue has been discussed in detail earlier, and at this point of time, since the matter is pending in the Honorable Supreme Court, we would not like to make any comment on this.
So, is there any provisioning to be made on that, sir?
No. What I am saying, the entire clarification on this part has been done. But at this point of time, to make a argument why there is no need to make a provision would not be correct, as the matter is pending in the Honorable Supreme Court.
Thank you, sir.
Thank you. The next question is from the line of Amay, an individual investor. Please go ahead.
Hello. Yeah, Amay, please.
Good morning, sir. Just a quick follow-up question on 81. Do we know when is the next date in the Supreme Court, and how do we know when is the date? In fact, I try to know, but I don't find a way to figure out when is the next date.
Actually, this was slated to appear today, okay? But it has not come in the final listing as of date. And I think we would come to know from the registry of the Honorable Supreme Court when it will come on the next date.
Got it. Thank you, sir. That's all.
Yeah.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Good morning. Two questions from my side, sir. First one is on the cost of funds. The increase has been for this quarter relatively smaller as compared to the last two quarters. If you could just tell us at your portfolio level, given the kind of maturity that you're seeing in your term deposits, how are you seeing the cost of funds kind of moving over the next couple of quarters? This is the first question. The second question pertains to the slippages that we are seeing on the retail portfolio. This quarter has been on the higher side. If you could just kind of give us a context into what is driving these retail slippages. Thank you.
Sure. On the cost of funding, to the first question that you asked, Mahesh, if you recall, we've been saying that the bulk of the repricing, has been absorbed till September. And since then, at least in terms of what we are observing as a pendency in deposit repricing, we're looking at not any material impact over the next 1 or 2 quarters. Having said that, Mahesh, what we also are conscious about are the industry and the liquidity landscape could mean that there could be room for us to continue to work on rates. Although our conscious effort is relative to the industry, we need to keep performing better relative to the industry. But as of now, when we look at the repricing or pendency of portfolio, there is a very minimalistic impact from a TD repricing on cost of funding.
And just to add on this question, let's say in the month of January so far, the situation on the deposit mobilization has been at par to last quarter, worsened, or it continues to remain, or it has improved? Where would you kind of put the situation today?
So, at an effort level, I have to say efforts are higher for mobilizing the deposits that we would have otherwise take. But from our perspective, I think the momentum in Jan continues to be similar to what we typically observe around this time of the year.
Okay, perfect. The second question on the retail slippages.
So on the retail slippages, obviously there has been a little bit of concern in the last couple of quarters brewing. So we took some measures in terms of the revision in the scorecards, BREs, also in terms of tightening the credit process. So I would say that more or less we have now reached a plateau, and from there we see that in the coming quarters we will see this getting in a stable state. But good part is that bucket by bucket there is an improvement in the resolution, So we see a better resolution in the coming quarters from this level. So our expectation is that the slippages will continue for 1 or 2 quarters. It will not rise from here, and then it will start declining.
Sorry, just to understand, what is driving these slippages? Which part of the product portfolio within retail?
So largely, the unsecured assets and also, some of the segments, few here and there, but those are minor. But largely, we have seen that, the unsecured portfolio needed a lot of corrections and very timely corrections, which have actually happened and now is showing the results.
Okay. Yeah. Thanks a lot.
Thank you. Participants who wishes to ask questions may please press star and 1 now. The next question is from the line of Sri Karthik Velamakani from Investec. Please go ahead.
Hey, hi. Question on the risk-weight assets. You've not disclosed the number. Could you, 1, disclose it, and 2, walk us through the movement to CET1 today, this quarter, particularly in the context of the BTA unwind and the consumption due to unsecured risk-weighting increases?
Karthik, hi. So the risk weight number is about 2.7 trillion rupees, which was about 2.58 trillion rupees in the previous quarter. So we had about 12,000 crores of increase, 12,500 crores of increase in the risk-weighted assets. Almost 7,800 crores did come in from the new RBI circular. Now, if I were to just split this from a capital consumption walk, like Prashant also mentioned in his opening remarks, we had about 40 basis points of burn that came in because of the new RBI circular. Outside of that, we had about a net 10 basis points of consumption, which was a function of both growth that we had, as well as the the profitability, the DTA, and some amount of continuous work that we keep doing on the rating profile plus the reg retail portfolio coming through. A combination of that, we had a 10 basis points of net consumption. But both profits and DTA release would be about 20 basis points of that work.
And the 10 bits decline due to the PSL shortfall is an implied profitability hit, is it, Rajan?
No, it's just that if you look at the balances increase that we've had about a net 10,000 crores of increase in the PSL shortfall deposits between September and December quarter. And as a consequence, we also end up allocating capital on that because it does attract risk-weighted assets. So, it's a function of that.
Oh, okay. So despite being sovereign guaranteed in nature, there is capital hit also due to PSL.
That's right. That's right, Karthik. Absolutely.
Okay. The other question is on our CA and SA growth. So generally, I think it was part of your opening remarks also that the CASA growth has been faster than system. And I see that the branch additions have not been that high. What's contributing to this, the higher CASA growth relative to where it is today?
So, Karthik, from our vantage point, so there are 2 things here, right? One, for us, we are operating at a 29.7% of CASA ratio. So we clearly have a priority to continue to improve our both current account and savings account, right? Number 1. Number 2, when therefore we look at an execution plan, clearly there is a higher amount of focus that is given to mobilizing the current account and savings account, right? Number 3 is we are looking at a loan growth which has been in the range of about 13%, and as a consequence, we are also looking at a deposit growth of 15 to 16%. In that context, we do find that delivering a growth of CASA, which is higher than our deposit growth, is something which we are all working towards, right? So it's a very focused execution plan, and a consequence of those execution plans are discipline around productivity, efficiencies at the branch level, monitoring profitability of each and every branch, making sure the incentive structures are rightly aligned, not only for just acquiring customers, but making sure that they maintain balances over a M3, M6 period as well. So it's a function and culmination of all of those elements, which we've been investing over the last 2 to 3 years. We are finding outcomes of those, and we're quite actually satisfied that I know 29.5% is not a very high CASA ratio, but we are quite satisfied that a lot of the SA that is also coming through, if I just look at over the last 1 year, it's not that our blended SA rate would have actually increased. So it's not that we are throwing rates to acquire the savings account. It's a function of very hardcore execution in retail, to drive the balances.
Thanks. I'll come back.
Thank you. Participants who wishes to ask questions may please press star and 1. The next question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hi. I have 2 questions on the Hello?
Yes, ma'am.
Hello?
Please proceed.
Yeah.
You're audible, yeah.
Yes, hi. I have 2 questions. The first is on personal loans that was discussed a bit. Why were tightening measures required in personal loans? What was your ticket size? Most of it would be salaried, right? So what was your ticket size? And in general, is there some read-through for the sector on that bit? And secondly, on just the realization of security receipts. I know it happens as and when, but is there any path you can guide us to build better estimates?
Okay. Now, first commenting on the first question on the personal loans. So our average ticket size remains around 2.5 lakhs. However, the segments which were a topic of concern for the entire industry were one was the NTC, the new to credit, which was contributing to almost 25% of the industry's acquisition. I think that which was showing a very good behavior for 2 years, started showing some stress. So at an industry level, there is a concern and there is a cut on that particular segment. The second one obviously is where the income levels were less than 30,000 a month. So these are the 2 segments which have been cut, and this is not just for us, but this is at an industry level. So having said that, I think the most of the concerns which we have tried to capture and try to bring the portfolio back on track are around these 2 segments.
Sure. And on the realization of SRs?
So basically, when we started, like when this transaction happened, we had the security receipts of 8,853 on gross basis, okay, which has already come down to 6,393 in 1 year. Okay. So fundamentally, if you see out of 8,853, almost 2,500 have been redeemed. Very, very difficult to predict when the remaining security receipts would be realized. But I think with the track record, we have not seen in 1 year more than 25% of the security receipts have been redeemed. And actually, we have also seen recoveries over and above the security receipt. And if you see the other part, we are continuously making the provisions on the remaining security receipt. And today, the net carrying value of security receipt has come down to 0.8%. Okay. And our provision coverage ratio on the security receipt is 73.2. Our objective is to bring down the net NPA and the net carrying value of security receipt below 1%. in the next few quarters.
Okay, sir, that's very helpful. Sir, just one more question. I know that your LDR has kind of stood steady. But in general, in the whole debate on LDRs for the industry, where do you think you stand? Because in general, for everyone, it appears that now LDRs need to come down. Do you think that that's the case for you as well?
So Madhu, we are quite happy with the LDR of around 90%. Okay, and this 90% is important for us in terms of both profitability as well as the keeping those kind of margins. But if you see that we are continuously focusing on the deposit growth higher than the loan growth. So at no point of time we are allowing our LDR to go below 90. It means higher than 90. And going forward also our strategy would be continuously deposit growth higher than the loan growth. But 90% for us is quite satisfactory, especially when you see a very large amount is being parked in the RIDF to take care of our shortfall in the PSL. So today 11% of our total assets are sitting actually in the RIDF. I think if you take into account this part, then 90% LDR is quite satisfactory.
Got it. So this is something that even the regulator would be comfortable with, right? Because there's now a sudden talk that the regulator may not be comfortable with LDRs of some banks, not specifically yours, but some banks. That's why I'm asking.
Yeah.
Okay, sir. Thank you so much. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. So firstly, on this unsecured piece that we have seen kind of some high slippages in the retail segment. So as you clearly mentioned, that is largely from the new to credit customer and not from the existing customer base. So usually means just wanted to understand the underwriting which we are doing so that there is no concern on that on the CIBIL score or on the based on the past track record if we are underwriting. So that should be okay, and only this is from the new to credit where the stress is coming up. Is that a fair assumption?
So, the retail business, which you fully understand, goes through its own cycles over a span of 5 years to 6 years. And whenever, there is any signs of stress appearing, the following actions are usually taken. One, to take the entry scores up, to tighten the criteria around the income levels and FYR. And third one is to look at the customers where you have a limited understanding, right? Your internal customers will always behave better because not just, you have information on their scores, but you also have information on their transaction history, right? So that will always make it more stronger, and they will always behave on a relative scale better. The concern always will be the new to bank customers, and within new to bank, then you segment which income bands you want to purchase or where do you see stress. You kind of again dissect it between the credit scores and then bureau scores, and then you again segment it between the profiles, the locations, the demographics. So you get into full detail when you have to review to tighten the criteria. So I would say instead of, and what I alluded to was some of the segments which largely, have shown signs of stress. But whenever you get into this cycle, and I would not say that we are actually into the cycle, but there was a bit of correction required at the industry level, and in line with that, we have taken actions across this. So it is not just cutting one segment. You have to take multiple actions to control, and fortunately, the signs are quickly seen in terms of your new to bank population, which is coming into as an inflow to the bank. So that is a positive sign.
Sure, sure. And so, sir, usually the FOIR for this below 30K customers, probably there is some stress. So, what will be the FOIR for that, 40-50% or even more than that?
So actually, so this is, today it is not as simple as it used to be a couple of years back. Today you segment the customer and then decide. Cat A company or a Cat B company or a Cat C company would all have a different approach to underwrite. So I would say there are multiple factors. It is a far sophisticated scorecard which today is applied as compared to the erstwhile file. So this is, I would say, the tightening on various fronts, not just the income to the loan ratio, but also to the EMI ratio, but also to the thresholds of what is your entry level for income. Even that is into the consideration, including, putting the Cat A, Cat B categorization of the companies from where the employee comes.
Sure, sir. And also, so secondly, on that profitability part, thanks for that, for the levers, the improvement in profitability. So we have mentioned that increase in organic PSL. So there were some talks earlier of acquisition, some inorganic acquisition to boost PSL. So is that still on? Are we still working towards that? And on the PSL, yeah, so firstly it is on that, yeah. And then I'll come to the last question.
Yes, there is work happening to find ways to accelerate the PSL journey for us. But having said that, clearly when you look at creating or acquire acquisitions, it obviously is time consuming. You need to have right fits, and there are multiple criteria that go into the evaluation. So it does take time. But I think having said that, I think it's important to note that it's not that we are just waiting for that lever to, express itself in our balance sheet. We continue to work on our own organic channels. We continue to work on other means of inorganic acquisitions into the balance sheet for complying with the PSL. And again, I will again refer to Prashant's opening remarks where he said that if we look at our problem in PSL, which is in subcategories of small and marginal farmers, non-corporate farmers, and weaker section, across these three subcategories, if you look at our compliance to PSL, we have only been improving quarter on quarter, and it's actually part of our presentation as well. So it's not that we are just waiting for this inorganic acquisition as a lever to come in and express itself. Yes, it will further propel and accelerate the acquisition machinery. But having said that, we are now looking at very nominal numbers of non-compliance in fiscal 24 across the subcategories.
Sure, and sir, one lastly, just on that 1% ROA mark, aspirational. So do we envisage that to come in FY25 or probably in FY26? What could be the rough timeline and sense on that?
I think that we need to be very realistic. And I think one of the big drag on our profitability is 11% of our assets sitting in the RIDF. Though we are working very hard and we are quite confident that this year there would not be any shortfall in the PSL. But I think the PSL book coming down to a normalized level would take some time. And I think this is the biggest drag. So 1% ROA we don't see happening in the FY25. But I think the way we are executing our strategy, we may see this 1% ROA in the FY26.
And then if I also add to that, 1% ROA for us is very important from the perspective of getting it delivered through core operating profits. And you would have seen that we continue to have good momentum, resolution, P&L write-backs through the security receipts portfolio. But you would appreciate that what we have been doing very consciously is actually using that to keep reducing the drag on our security receipts and continue to work on improving the PCR, right? So I think just to mention that ROA 1% target is being thought about from a core operations and not just for a number from a profitability, because ultimately we want to get our NNP and SR also below 1% from the recoveries of the SRs.
Sure, sir. All the very best. Yeah. Thank you, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Dinesh Jain, an individual investor. Please go ahead.
Good morning, Mr. Prashant. So my two questions on basically every month, every quarter, you guys are disbursing about 30,000 crore rupees of loan, which amounts to, and in annual report also, you are disclosing that you have about 1 lakh crore rupees of disbursement in a particular year, which amounts to 50% of your portfolio. So despite doing that, your growth is at about 15%. So it means your average loan size is somewhere about 2 years or something like that? Why it is not translating it into the growth? That's point number one. Point number two is in the provisions this time the default on personal loan is about 1,000 crore. Your total net interest income for the year is 2,000 crore. So if your 50% of your portfolio is towards personal loan, which is about 1,000 crore, and you have already you are defaulting, your defaults are 1,000 crore in a quarter. Is it mean that 100% of your personal loan net interest income is getting defaulted? So is it some bigger underlying thing is there which we are not understanding, or is it the earlier Yes Bank which is returning now to the fore?
So, Dinesh, on the first question of disbursements, so when disbursements happen, there are also repayments that keep happening in the book. So I'll give you an example of the large corporate business where clearly we have pivoted away from the kind of large corporate business that we used to do prior to March 20. This is more working capital in nature, transactional in nature. And yes, we do have a significant amount of fresh disbursement, fresh lines that get set up. Yes, utilizations could have its motions of, some quarters the utilizations are high, some quarters utilizations are low. But I think the momentum on new business acquisition is very high. But having said that, in the large corporate book, despite the new disbursement, and you would have also observed that, we have seen degrowth in that book over the last 2 to 3 years. That's because of our legacy book that we had in the large corporate. We've seen repayments. A lot of those we were consciously triggering those exits so that we continue to reduce the legacy assets that we had in our balance sheet. It was also one of the strategies for us to reduce those exposures because they were also coming in from, let's say, real estate or hospitality. So that journey also coincided with the new acquisitions that were happening in the large corporate, and as a result, what you see is a net function on the loan growth. That's number one. Number two is if you look at similar comparison on the retail side. On retail, what we are seeing is a disbursement run rate of about anywhere between 10 to 12,000 crores, let's say, that we might be doing per quarter. But equally, we would be having about 6 to 7,000 crores of, let's say, repayments and maturities that happen every quarter. So what again you see as a net result is post the repayment. So what we are seeing is 15% 13 to 15% loan growth, I think is fairly reflective of new business origination as well as old. The last point I wanted to make is when we look at disbursements, it's about making sure that you are penetrating into the relationship of clients. What we are quite confident about is that now that we are entering and acquiring large-scale customers across, when I say large-scale customers across corporate, mid-corporates and MSME, we have a good hook now on these customers, and as and when utilizations pick up, you will also start seeing those on the loan growth. Right? So I think that's just a simple explanation I thought I should provide. That was the first part of the question. I think the second question you asked was on provisions and NII, which we have about 2,000 crores of NII, and I think the question was you were correlating that with 1,000 crores of slippages, right? So I think the first point there is when you look at the NII, we are looking at NII also has multiple elements of drag, and I think we spoke about Prashant mentioning again and again that there is a significant drag coming in from the existing stock of RIDF, which is sitting today at about in excess of 40,000 crores on our balance sheet, 11% of the total assets. So I just want to contextualize that 2,000 is in the first place not a normalized run rate of NII that we should be looking at. That's number one. Number two is, like Rajan mentioned, when you look at 1,000 crores of slippage, you do go through cycles where there will be certain uptick in performance or delinquencies in certain products, in certain geographies, in certain segments. But I think that is where management intervention comes in, is to say, okay, have you identified the problem and have you taken course corrective actions to make sure that incrementally, you are kind of not repeating those geographies from a disbursement perspective. And I think we're quite pleased to see that we have taken the necessary actions to plug the new slippages. And like Rajan mentioned, we do believe that the run rate should start normalizing or reducing from here on. I think the third thing which you also have to look at is it's not just the gross slippages. There is also a run rate of recoveries and upgrades that we see. So while for the full bank, if my annualized slippage ratio is, let's say, 2.3%, actually the net of recoveries and upgrades, the ratio would be about 1.1% to 1.1%, right? So it's not that the whole block of 2.3% goes into a loss. There are recoveries and upgrades that do happen over a period of time. The last part I wanted to mention is, again, while the impact of this was acute in September, but we did see some element of that also play out in December, is we also had an accounting policy change where, we did go through some explanation in the last quarter, so I'm not going to spend a whole lot of time. But that meant that because of the accounting change in penal interest, the delinquency was slightly higher on the retail book. But to summarize, we do believe that the relevant course corrective actions have been taken, and the delinquency should start stabilizing to reducing from here on.
Sure. Thanks. That answers my question. One last point I wanted to say on this whole priority sector thing and all, which suddenly got popped up into this particular slide. So were you guys not aware last 3-4 years that this particular thing was you didn't see it coming and suddenly this has popped up this particular quarter? Or you were knowing 3-4 years back and you were working on it and nothing happened, and therefore this quarter it has popped up that this has become now a new reason on the block?
So, Dinesh, that's not, to be honest, if you go back to our commentary also about a year back, we did mention that we are keenly evaluating acquisition of an MFI entity or entities that might be the MFI business. This was all keeping in mind that the bank needed to solve its PSL subcategory acquisitions, right? So we were aware. We have been talking about the drag that RIDF is causing. It's just that we have brought that out explicitly, so that because we were getting these questions time and again, and we were explaining on calls, through our commentary. I thought it was just important that as an entity we put that out in absolute clarity as to what would be the drivers, on improving the PSL drag and what is the drag. So we just put that out in black and white. That's the only difference. It's not that we were not aware, nor that we have not been guiding as to whether this is a problem statement for us or not.
Sure. Thank you.
Thank you. The next question is from the line of Narendra Podwal, an individual investor. Please go ahead.
Sir, namaskar, Prashant Kumar ji.
नमस्कार
सर। तो सबसे पहले तो मैं आप लोगों को धन्यवाद दूंगा कि हमारी बैंक के प्रति आप लोगों की जो कमिटमेंट है मैनेजमेंट की, कि मंडे मॉर्निंग को 8 बजे आप फोन कॉल करते हैं मार्केट स्टार्ट होने के पहले। तो ये आप लोगों की कमिटमेंट और कॉर्पोरेट गवर्नेंस दिखाता है कि आप लोग कितने एग्रेसिव हैं। सर मेरा क्वेश्चन कासा के लिए रहेगा कि सर आपने आगे भी आंसर दिया, सर हमारी कासा अभी तक भी दूसरी बैंक के मुकाबले बहुत कम बढ़ पा रही है। और सर मेरा जो एक सोचना है कि मेरा अकाउंट ऑलरेडी यस बैंक में ही है सर, लेकिन हम इस समय जितने आईपीओस आ रहे हैं, बहुत सारे आईपीओस आ रहे हैं और काफी अचानक इन्वेस्टर्स बहुत एग्रेसिवली आईपीओ करते हैं सर, और वो लोग काफी बैलेंस मेंटेन करते हैं। लेकिन फिर भी हमारी बैंक में सर कट ऑफ टाइम 3 बजे का रखा हुआ है, जबकि और बैंकों में 4 बजे का रखते हैं। सर हम लोग क्यों एग्रेसिव नहीं बनते हैं सर? हमारे कंपैरिजन में दूसरी बैंकें काफी एग्रेसिवली मार्केटिंग कर रही है कि हम 7% दे रहे हैं, 6% दे रहे हैं। हम भी सर 6% के आसपास सेविंग रेट अकाउंट में इंटरेस्ट दे रहे हैं, लेकिन फिर भी हमारी कासा उस तरह से नहीं बढ़ पा रही है। सर मेरे को भी काफी दिक्कत आती है, लास्ट टाइम में हमारी सिस्टम काफी बार बंद हो जाती है। तो सर इस तरह का प्लान कीजिए कि टेक्नोलॉजी का टाइम है सर, आप थोड़ा सा टाइम बढ़ा के एक एग्रेसिव मार्केटिंग कीजिए, तो हमारी कासा वहां से काफी इंप्रूवमेंट होगी। और एक बार कस्टमर हमारे अकाउंट खुलाएगा तो दूसरी बैंक में नहीं जाएगा सर।
तो कोटवाल साहब आपका बहुत बहुत धन्यवाद। ये बहुत आपने इम्पोर्टेंट हमें फीडबैक दिए हैं। और देखिए हमारा जो पूरे बैंक का अगर आप देखें जो फोकस है वो बिल्कुल कस्टमर सेंट्रिक है कि किस तरह हम कस्टमर को सुविधाएं और दे सकें। पर आपका ये जो सुझाव है कि 3 बजे की बजाय अगर हम इसे 4 बजे कर सकें, बहुत वैल्यूएबल है, हम इसको देखते हैं। मैं आपको सिर्फ कासा डिपॉजिट में सिर्फ एक चीज बताना चाहूंगा। आपको मालूम है कि 4 साल पहले बैंक जिस हालात में गुजरा था, जहाँ पर हमारे डिपॉजिट आधे रह गए थे।
बिल्कुल सही है सर।
थोड़ा सा टाइम लगता है जब डिपॉजिट पे, पर हमने इस 4 साल के अंदर जो डिपॉजिट है हमारे 2 गुना से ज्यादा बढ़ चुके हैं। और अगर आप देखें पूरी इंडस्ट्री में हर बैंक का कासा रेशो कम हो रहा है, पर कम से कम हम लोग अपना जो कासा रेशो है उसे प्रोटेक्ट कर पा रहे हैं। वो कासा रेशो हमारा कम नहीं हुआ। और ये सब इसी वजह से हुआ कि आप जैसे जो कस्टमर्स हैं उनकी हमें जो पूरी सपोर्ट मिल रही है, ये उसी वजह से है। पर हमारा भी ये कमिटमेंट है और आपको पूरा विश्वास है कि जो कस्टमर के लिए हम, चाहे वो टेक्नोलॉजी या एक एग्रेसिव मार्केटिंग जो आपके सुझाव है, उस पर हम पूरा ध्यान देंगे।
सर मेरा अकाउंट ऑलरेडी जब बैंक में तकलीफ आई थी तब से भी ऑलरेडी अभी तक भी कहीं भी डिस्टर्ब नहीं हुआ है। मेरी ऑलरेडी काफी बैलेंस रहती है। और बहुत बार क्या सिस्टम बंद रहता है तो हमें फिजिकल फॉर्म भरने होते हैं, तो ऊपर से बैंक के ऊपर प्रेशर आता है कि सर आप ये लोग क्यों आप बीड कर रहे हैं, एंड टाइम में बीडिंग क्यों कर रहे हैं सर। ये सब क्या है, दिक्कत बहुत होती है सर। आप लोग मतलब क्या है बहुत एग्रेसिव है, लेकिन आपकी टीम को भी बोलिए कि थोड़ा सा एग्रेसिवनेस बने सर।
साहब राजन बोल रहा हूँ। आपके सुझाव और जो आप हमें फीडबैक दे रहे हैं उसके लिए बहुत बहुत धन्यवाद। मैं आपके साथ अलग से आपको कॉल करके और समझूंगा आपकी क्या प्रॉब्लम है, जिसको हम दूर कर सकें।
और काफी कस्टमर मेरे काफी क्लोज रिलेटिव हैं जिनके 2 करोड़ बैलेंस रहते हैं, वो लोग दूसरी बैंक में शिफ्ट होने का ट्राई करते हैं सर। तो ये क्या है कि इस तरह से क्या है कि मास मतलब क्या हमारी कासा बहुत एग्रेसिवली बढ़ेगी सर इस तरह से।
नहीं बोलो सर, बिल्कुल बिल्कुल आपके जो सुझाव है बहुत वैल्यूएबल है। विल वर्क ऑन दिस। और आपसे राजन जो है वो पर्सनली भी बात करेंगे।
ठीक है सर, धन्यवाद सर।
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yes, sorry, sir. I had a follow-up question again on the personal loan bit. So basically, we have weeded out all the customers which were probably looking a little discomforting, and because of closure of lines to them, these slippages have occurred, or because anyway they were on the lower income side, these slippages have occurred. As in that, were some of these BNPL customers given? May not be, right, given that your ticket size is high, or how do we look at the whole piece?
So ma'am, first of all, BNPL came as an experiment and it failed. So fortunately, we never tested waters into that particular segment. Two is once a customer has come in, you have to bear him for 36 months. So it is not that, you can weed him out in between unless you proactively go back and insist that you close the account, which generally is not the likely situation. In our internal database, proactively when you are looking at acquiring a customer, obviously we did out that set of customer which we potentially were putting it up to our teams to acquire. So from that extent, you are right. Also from the customers who are coming out from the outside market, we have, since we have tightened the criteria, so these customers will automatically get rejected. So from that extent, for new to the bank or from existing customers, certain segments have been eliminated, but this is nowhere close to the BNPL model. These are the normal personal loan customers.
Got it. So for going ahead, will growth in personal loans be slower than earlier only?
I think growth is not that issue because there are a lot of customers and personal loan is growing at a particular pace. But whenever you will do any kind of policy cuts, temporarily there will be a dip in the business and then you again ramp up because you have a large distribution out, which also then alters their way of acquiring and bringing back the customer to various banks.
Got it. But so the key reason for the slippage would be what then? As in, it's just that the income levels did not support, or what would it be in general?
So I can tell you
the 36 months lapse for many this quarter.
No, so I will give you an industry level answer to it, and obviously, these things do reflect in overall across portfolios. One is that customers taking more than one loan after they have taken from you, right? That tends to be one of the bigger reasons. And secondly, it can be around the income levels not going up or the inflation being high, the disposable income coming under stress. So there could be various ranges, and the retail portfolios, throw you a lot of opportunities to get insight into the portfolio in various squares, which you have to then cut and then kind of look at what is going to be a new acquisition strategy. But having said that, even in personal loans, even if I dissect the quarter between the 3 months, we have seen a very good month, December month, whereas the resolution rates have really gone up to upwards of 87%. So the resolution rates have become better. So these customers who have defaulted, their resolution rates are getting better.
Got it. Okay. Thanks a lot. Thank you.
Thank you. The next question is from the line of Mrunal Shekhar, an individual investor. Please go ahead.
I have. There is too much deviation from the listed security house analysis and why there is too much negative number in retail segment.
Sir, can you repeat your first question? Deviation in which element you want us to clarify?
Because market has accepted too much profit in this quarter. Means from the reputed house analysis, security house analysis, like ICICI Securities has accepted figure around 500 crore profit at this quarter, but we have got just something 281 crore net profit, and MK Capital also analyze too much profit, but we get less profit than this number.
तो Mrunalji इसमें
and also one more thing I want to add, there is too much speculation is spread around in YouTube and this YouTube. What are you doing in this regard to control this news?
Sorry, Mrunalji, आपकी आवाज ठीक नहीं आ रही थी. We were not able to hear you well. I think the first part of the question which we could gather was around that the market expectation was a certain number and we have delivered a certain number below expectations. Is that a fair question?
Yes.
Okay. So let me respond to that, and maybe we can come back to the second question. Muralji, to be honest, we will not be able to comment and let's say on every quarter's expectations that markets will have. I think at the start of the year, we've been saying that there is a certain path to our profitability to a 1% ROA, and which is a journey which requires a lot of execution, focus. It was a 2 to 3 year journey that we had highlighted. Number one. Number two, as the kind of period plays out, of course there are a lot of external factors that also come in, and you would appreciate that over the last 1 year there has been a significant spike in interest rates generally in the environment as well, which is resulting into NIM compression not only for us across all the banks. But I think there are certain principles with which we work. There is a certain strategy which is in place, and we are sticking to that strategy. And just from a profit standpoint, because that was a specific question that you had, for us, it's very important to get the NNPA and security receipts also below 1%, right? So it's important that we keep improving our PCR for the bank, we keep reducing the drag, and keep working on expanding the operating profit, right? And that's a work which we keep executing day in, day out. We also take, by the way, through this question of a feedback that maybe the expectation itself in the first place needs to be managed better, and that's something we will be happy to communicate more emphatically and effectively on an ongoing basis. Yeah, we're not very clear about your second question. If you can just repeat the second question.
I'm sorry, sir. The participant has already left the queue.
Okay.
We'll move on to the next question, sir, which is from the line of Srinivas, an individual investor. Please go ahead.
Yeah, good morning. I have two questions. Actually, what is the guidance for this ROA accretive products from the current level of 55%? As at the end of FY25, where would we expect it to be? And what would be the impact on the bottom line? And second question is, like Prashant sir was saying that from 8,000 and odd levels, like the security receipts on the ARC portfolio have come down to 6,000 and odd. 25% recovery has happened. But if we see the presentation, like the security receipts as a percentage of advances is only 0.8%. That comes to roughly 1,850 crores. So what is this difference between 1,850 and 6,000 and odd, 4,000 plus crores? Can we assume that like once the provision becomes zero, entirely this 4,000 crores would be accretion to the profit, bottom line?
Yeah. So basically 0.8% is the net carrying value of SR, security receipt, after making the provisions. And once, like, if net carrying value comes down to zero, then whatever recovery would come would be directly addition to the P&L.
Okay. The second question?
On the ROA accretive products, our objective is to, and again, the first point there is, we are talking about, large scale distributions. Therefore, the path towards migrating towards a higher ROA accretive products is something that we keep calibrating over a period of time. Currently, which we are running at about 55%. The trajectory would be continue to improve that. You would continue to see about 5 to 10% improvement in that mix over the next 6 to 9 months. I think that's really where we will continue to work. Now, what does that mean from an ROA perspective? Ultimately, some of these products on the margin, I'd say again there are two elements. One is on the margin and what it does to the book. On the margin, which means to the disbursement mix, these products are already generating an ROA which could be about 60 to 70 basis points higher than what let's say the other products would be. But for those to get expressed on the book, could take about anywhere between 2 to 3 years. So It is like on the margin, you might end up making today about 2-3 basis points on the book every quarter, but it will take some amount of time before it starts getting reflected on the book.
Thanks.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I would now hand over the conference to Mr. Prashant Kumar for his closing remarks. Over to you, sir.
Again, thank you everyone for joining our earnings call too early in the day. Thank you so much, and wish you all the very best.
Thank you very much, sir. Ladies and gentlemen, this brings the conference call to an end. Thank you, members of the management. On behalf of Yes Bank, we thank you for joining us. You may now disconnect your lines. Thank you.